Welcome, everyone, to another episode of Macro Matters, where we talk about the macro that matters. My name is Rich Excell. I'm a member of the CFA Society, and I'm here with my co-hosts, as usual, Blaine Reed and Tony Zhang. Welcome to Blaine and Tony. Thanks for joining today. Here we are in the post-tariff times, and thought we could maybe talk about that among other things. So, welcome.
Hi,
Yeah,
Rich. Hi, Tony. Great to be here. Thanks.
yes, yeah. Hi, Rich and Blaine. Definitely. Seems like our last episode, definitely there were a lot of things that are happening, including the tariff and other political events. There's a lot of things going on. Then I think that today will be a good time for us to actually catch up over what have happened over the market and what does that really mean for us.
Yes, for sure. And as usual, I'm going to have my Bloomberg up, so I'm going to share some screens. We'll talk you through that and we'll discuss what we see. But like Tony said, it's been a while since we took the 4th of July holiday off, but we've gotten tariff news and here we are recording this on July 14th. So we'll get CPI tomorrow on the 15th and PPI on the 16th. And of course, the Fed comes out later this month, but it's not just the FOMC meeting that we worry about. It's the or thinking about. It's the whether or not Jay Powell is going to get fired from his job. So there's a lot going on with the Fed, even when there isn't a Fed meeting. But to kind of tee that up, I wanted to kind of get your thoughts here. Hopefully, you can see my screen. Um, on CPI. As I said, the CPI is coming out tomorrow. As you can see, it's been every month every month we've had it coming out this year. It's nudged a little bit lower, and I think people are extrapolating that month over month into a year over year number. As we see, the year over year expectations are still at 2.6%, well above what the Fed's target. And some of that I think is being driven by the next chart that I have, which is the year over year change in M2 versus CPI. I have the M2 leading here by about 18 months, and you can see that um, you know it's the M2 rise and fall around 2020 to 2023 definitely help predict CPI, that availability and flow of money. As Milton Friedman would tell us, inflation is always and everywhere a monetary phenomenon. I think others might disagree, but if it is a monetary phenomenon, it's moving back higher. And I just kind of parlay that into my next chart, which is what I call CPI forecast. And I look at a very simple index here, four measures. M2, of course, but commodity prices, PPI prices, so what the companies are paying. And then we have to question whether or not they pass that on. And the last thing is consumer inflation expectations. And so those four things, I put them in a simple index, and I compare that to the year-over-year change of the CPI, and you can see that it until 2023, it did a really good job of predicting what would be happening with CPI. And since this year, it's telling us that CPI should be going higher. It hasn't yet. I'm not suggesting the government's playing around with the data or not. At least maybe not right here. I'm not doing that. But maybe I want to get your thoughts. We'll start you, Blaine. You look at a lot about the availability and flow of credit in the economy. So when I show you those M2 numbers and I show you the liquidity numbers potentially suggesting higher inflation, what are your thoughts that come, what thoughts come to your mind?
I think this is probably parlays right into the Fed wanting to wait and see, at least for the time being. I think they're looking at probably similar indicators and just wanting to make sure that they have a grasp, or at least CPI continues in this downward trajectory, and that we don't get an uptick, as history would suggest that we might, given where kind of M2 is going. So I think we talked a little bit in the last podcast about the Fed in a wait and see mode, at least maybe till later this year. And I think data like that, no matter what the president might like, right now, I think this is what the Fed is wanting to wait and see. There's just a lot of cross currents, and and even when you listen to companies and inventories, a lot of what has been sold, or at least what you read in the press, has been sold, called the first 6 months of the year, was pull forward of inventory that was pre-purchased. And now we're going to start getting into the inventory that might have been purchased with some tariffs attached to it, and how much of that is going to go through and flow through either to the consumer, or the company itself might eat some of that in margin. So I think we're kind of at that crossroads now where we might start seeing some of this show up in the data, and the Fed is wanting to see that. So that would be my initial take.
Yeah, I want to jump on the tariffs in a second because like it started at the top. We want to talk about those tariffs today, but Tony, one of the our biggest arguments I hear for why inflation shouldn't be a problem are things like commodity prices and PPI, and still looking at saying, okay, China, which is still the biggest producer in the world, is deflating. You're seeing their PPI falling, and historically, there's a big relationship between China PPI and U.S. PPI, and so and frankly, here in the U.S., PPI has been relatively well behaved, but we can see that commodity prices are not behaved. Maybe it's because of tariffs like on copper, et cetera. But when we think about the deflationary elements of what used to be China deflating everything, and you wanted to buy what China was buying and sell what China's selling, but we're not seeing that trickle through into the CPI here in the U.S. So what are your thoughts on that, and is that relationship finally broken?
Yeah, Rich, at the beginning of this year, I remember this is I call on just a buy like allocated or allocating some of a portion of the total asset into the Chinese stock market and also Hong Kong Stock Exchange, which actually turned out to be very strong. Like the Hong Kong Stock Exchange turned out to be the leading exchange for investors' return. Now here, I think this is just the starting point, and it hasn't really turned around. And given what the current president's like a strategy over the tariff, I would anticipate that more and more of the capital in Europe and South Asia would continue to flow out from the United States, partially to China, where a lot of investors find the relative value. I mean, cheap, way, way cheaper, given the similar company like IT or AI company, the relative valuation of this company to the counterparts in the US stock exchange. I think this wouldn't change. And back to the point, back to the question you mentioned about like we continue to see the weakening of the CPI and PPI data in Chinese manufacturing. And given that the strong correlation and positive correlation of the Chinese PPI index to the US CPI and PPI counterparts, that's actually explains a lot of the things why we hasn't really seen the CPI or PPI to actually come picking up here. I think this will give a lot of justification for President Trump's like a strategy is just to asking the Federal Reserve to lower the interest rate. And in my opinion, that should be the case. And I actually think it might be better off overall economy if like Chairman Powell can and also the Fed can actually lower the interest rate faster than what they actually projected, maybe 2 to 3 times. Maybe they might even take even better, faster. This is actually I align with that side. I know you and Blaine actually disagree. I do not see the inflation would continue to pick up because the tariff by itself is a counter inflation because the higher tariff you can imagine the higher price. Yes, certainly, sure, but actually the higher price will means like a lower demands based on the purchasing power of the current consumer within the United States. So actually, I would argue that the counter effect of the higher tariff actually should lower the CPI and PPI data in the US overall economy. So it would be better to actually cut the interest rate here earlier. That's the overall my I would say my projection, Rich.
No, I want to get to that flow of funds and what and Chairman Powell, et cetera. But kind of just looking at the tariffs and bringing up the kind of the tariffs page, we can see the U.S. all partners tariffs here. This is on Bloomberg is showing about 9% tariffs right now is the latest. 1 month's change has gone higher, and having seen some work from some of the economists out there, it is showing that consumers are in fact paying a big portion of these tariffs right now. That companies are passing that along, and so that is something that we want to kind of to be thinking about. Is that I know there's been some debate. I know the president would suggest that China was going to pay all the tariffs, and I think. There's the sense that maybe companies are going to eat some of that as well. But the reality is that these higher prices that we're seeing are definitely being passed along to consumers, and consumers are paying it. And I think to me, maybe that's a function of the wealth effect with stocks at all-time highs and crypto at, or Bitcoin at least at all-time highs. And maybe house prices are no longer at all-time highs, but the wealth effect might be leading to much to much higher spending out there. But from that standpoint, maybe we want to talk about how all of that might be influencing the bond market here. And so, Blaine, I want to kind of pivot to you. Um, the U.S. 10-year Treasury at 4.43% right now sounds attractive, right? But I think when we look at that on an FX hedge basis for global investors, um, it's not as attractive as you think. And actually, I did this analysis before, and the most attractive bonds out there in the world for our global investors, whether they be U.S. investors or European investors, are actually JGBs. If you have FX hedge JGBs, you're getting somewhere between 5 and 6% yield on an FX hedge basis. And so treasuries at 4.43 just don't look that attractive to investors outside the US. And I imagine that even if we're going to see the chairman of the Fed replaced by political will instead of other reasons that might make investors in the bond market even a little bit more worried about that. So how should we be thinking about the bond market here, at least from the 10-year standpoint?
Yeah, this chart is interesting because you look, we were kind of on a downward trajectory, from call it mid-May, and we hit what about, I don't know, about almost 420. And so we're about 23 basis points wider. And I don't know if that is, the timing of the big beautiful bill and speculation about how much, a debt is going to be added to the system and, potential cost to that. You've got the tension with the Fed not lowering rates because, he views that would save interest costs, the way that he wants to finance his debt increases. So I think there's just a lot of underlying cross currents. And I think the market, on your earlier chart about, call it 9% on tariffs. The question I keep asking myself is what is the market really pricing in? Are they pricing in 9-10% tariffs? Are they pricing in something more? And we didn't get the more last week. We got another moving deadline and potentially more. And then some other things, other announcements along with that. And I think it's really difficult for the market to price in what expectations should be. So maybe this is an attempt at that a little bit with the widening we've seen on top of the big beautiful bill. So I don't know if we go much higher than this, but it does feel like to me it's the right direction, if that makes sense. In
For sure. And then when you look at it, if I
yeah.
add that to look at now the US yield curve, the 2-year, 10-year, the one of the more popular trades it seems in the bond market is the steepener, where
Mhm.
people are expecting the Fed to get pressured into cutting rates, as Tony and others are calling for.
Yes.
But they also understand that that's probably not the right answer, which is why the 10-year yield is moving higher, even while the 2-year yield moves lower. And then the bond market vigilantes are saying, okay, that's fine, but guess what? If you want to fund yourself, you're going to have to pay a higher rate. So Tony, is the steepening of the yield curve an indication that we might get rate cuts as you're calling for, but at the same time, that might not be what that might not be what the bond market wants to see, and there may be some struggles in terms of being able to fund the trillions of dollars of new debt that we have to issue this year.
Yes, there is a lot of underlying reasons as what Blaine just suggested, which I highly agree. And as what my actually projection here is, I think the 10 years and longer uh, duration bonds, like a yield, will continue to go higher and continue to much higher from here. Like given the trillions of dollars, like a new national debt ceiling being raised after the big beautiful bill. As what we discussed in the last episode, I really concerning that the big beautiful bill is going to really raise our national debt significantly, as well as the interest payment. And from the international institutional investors' point of view, especially the some governments like and investment arm and also the endowment before actually pulling the trigger to buy more of the U.S. Treasury bill. They definitely demand a high interest rate and higher yield, given you will continue to actually print more. And the U.S. government, under the current the bill, will actually execute that kind of a command. So if actually they raise more of the debt for current administration, there are only actually two ways to get funding. One way is that when they actually issue more of the bonds, selling more of the treasury bill, one way is that the Federal Reserve come in to actually print more of the money and then basically conducting the QE instead of a QT, as what Federal Reserve is doing right now, conducting another round of the QE to making sure that enough liquidity will be provided to the current administration. Or the other way is to raise the capital from the foreign institution, okay, including the government agency as well. But that actually it's going to um, basically threaten a lot of the institutional investors' interests by actually buying more. And if we actually do not actually pay more, what's gonna happen is the more and more of the U.S. like a dollar outside of the United States will actually flow inside into the current administration, flow into the U.S. territory with a higher yield. But that actually causing another biggest like a side effect that people might actually underlook or people might already forgot. That was actually one of the reasons that caused the Asian's financial crisis back to 2007 and 2008. That was the moment that whenever we have a higher tariff and simultaneously raising the national debt, this is actually going to look at it as like a black hole to suck in all of the US dollar liquidity outside of the US into the United States and simultaneously living a big host outside. And because of the high yield here in the US Treasury bond, what we can actually see is for those kind of foreign investor who actually already hold it long-term like US Treasury, their loss continue to increase, right? Because when the yield higher, the valuation actually go down. Lots of those kind of institutions is outside in the foreign market actually would have to take the loss. Whenever they take the loss, they will actually sell more of the current holding into the market, causing the yield to spike. This is something that we haven't really seen, but this is what happened in 2007 and 2008, causing the Asia's financial crisis. And so apparently this is a way that to avoid that, which actually will be the Federal Reserve to come in actually to to reverse the trend of the higher U.S. Treasury yield going higher. But because we haven't really seen the Federal Reserve willing to do so, even from the recent Chairman Powell's like a willingness to lower the interest rate faster than before in his remark. This is my set up a big risk for the financial market outside of the United States. So this is really concerning me. I think the trend will continue to go higher before we see it turning lower. That's my point, Rich. Blaine.
Yeah, and I would
Yeah.
say that, like I mentioned, on an FX hedge basis, U.S. Treasuries just are not that attractive to Japanese and European investors, and
Mhm.
so, and I think that we see that because Treasury Secretary Bessent tried to take a page out of Secretary Yellen's book back. You remember back in, as I have the chart of the 10-year up here, back in the September, October 2023, when she indicated that the Treasury was no longer going to issue long end, they were only going to issue bills. And she was soundly criticized at the time, but what it did is it created a duration shortage. And so everyone in the market raced to go out and buy duration in the 10-year Treasury, taking yields from 5% down to below 4%, which led to a massive rally at the end of 2023 in
Yes.
small caps and a whole bunch of other types of indices. Besson and Trump tried that game here in the last month or so, saying that they're not going to pay 4 and change percent. They're going to issue short term. And the Treasury market responded by saying, okay, yields are going to go higher. They're not going to go lower. The
Of course,
duration
it have
shortage
to.
was not created the way they were hoping it would be created because I just think the treasury market is not that appealing to them. And I think they also understand that um, there's just a lot of capital flowing around and is flowing into other products. And I wanted to kind of bring that up and show you guys like if I bring up the this is the relative rotation graph where we can look at what sectors in the US market are performing relative to others. I mean, you still see that you've got industrials and technology are still some of the leading sectors. You've got discretionary proven. I mean, the equity market is acting as if there isn't going to be any sort of recession whatsoever. Like we're still very much in growth mode. And if the equity market's saying we're very much in growth mode, and the financial conditions are very easy, and M2 is growing, and the stock market overall is at all-time highs, and crypto is at all-time highs, uh, that tells me that the Fed and Chairman Powell, even if he's going to be pressured by the president, are going to wait and see as we kind of get towards the end of this month and into the summer. Blaine, I know we're on the same page, but how would you argue further against Tony that maybe we're not going to see maybe not only that we're not going to see the rate cuts, but that we shouldn't see the rate cuts?
Yeah, I keep using the word uncertainty and cross currents, and this might be not the most perfect analogy, but if you think of the U.S. government as a business and they're going to their banker and trying to raise more debt, and the banker says, yeah, yeah, okay, this doesn't look that great with your kind of run rate EBITDA, but then the U.S. government says, but I have all these add backs. And I have all these tariffs and everything else we need to add back into that EBITDA, and then Shazam, it works. But are those forget about who's for a second about who's paying the tariffs. Um, but are those tariffs permanent? What happens if we negotiate them 6 months from now and they go away because we like everyone and now we've levered up the U.S. government to a run rate of EBITDA that's not necessarily there, and we have to grow our way into that balance sheet. And I just think through this kind of a lens, the market is saying we're kind of getting to a level here where we kind of need to pay attention, and we need to see what is actually in the big beautiful bill. We need to see the impacts from that. We need to see the impacts from tariffs, and how permanent they're going to be and at what level. And I think we're just now getting into that part of the calendar, or that part of the business cycle where we're going to start learning some of that. And so I think until we see that, I don't see a big case for rates to come in on the longer side. And I think that the Fed is somewhat in a wait and see mode. I mean, so that would be my pushback. We're expanding our balance sheet, and we need to see where the revenue generators are coming from.
And you bring up a good point, and here we are, July, like I said, July 14th. We're going to be starting earnings season here in the
Mhm.
next couple, few weeks, and the company commentary is going to be certainly quite meaningful. And I would think the Fed wants to hear that. Looking at the sector performance with technology and discretionary doing well, but with energy and materials not doing well, historically, as I would tell my students in portfolio management, that tells you that the market thinks we're going to have higher growth and lower inflation. And we're not going to see any inflation. We're not going to see that CPI higher. And so maybe I don't know if that argues for lower rates, but it certainly doesn't argue for higher inflation. But I also think if I kind of look at this kind of global map here of what's working, what's not working, we're starting to see Tony, a little bit of I wouldn't say a broadening of the rally within the equity market, but as we see, uh, in the leading category here, we've definitely got crypto with Bitcoin leading the way, but Ethereum has caught up massively. It's been a dog and it's been really moving much, much higher. You're seeing silver start to move a lot higher relative to gold. You're seeing high short interest stocks starting to move higher. You even see the small cap stocks moving into the leading quadrant there. So that sounds like a lot of the stuff that's been left behind is catching up here. That tells me that the market thinks that there's a lot of liquidity out there and it's time for the catch-up trade, and that doesn't necessarily scream time to cut rates. But Tony, I'm gonna punt it back to you. What you're seeing all these different asset classes move and all the movements within asset classes that don't seem to suggest that we're in a point where we need to cut rates because the Fed cut 100 basis points last fall, and that's only just now getting into the system. Maybe wait and see is the right thing, but I know you don't think that way, but try to convince Blaine and myself.
Yeah, Rich Blake, I definitely understand the concerning factors that you two have, and to be honestly speaking, to be honest, I really agree with both of you that those concerning factors remain there and will continue to be a major risk factor over the market. But we always see some also supporting factors like in emerging market in the U.S. As well, which actually might continue provide some support for the momentum of the U.S. market going forward. One of the major issue apparently is about the big beautiful bill, and as what Blaine just mentioned, we are still taking some wait and see approach. We here represent Federal Reserve is taking a wait and see approach to see how the tariff and play into the impact of the CPI, and simultaneously, we might also want to monitor how the rate cut, the tax cut within the big beautiful bill will actually have impact over the U.S. Stock company valuation. And from the, I think the first term of President Trump in back to 2016 to 2020, we have already seen that investor gave a huge applaud to the tax cut for the corporation, especially the tight large cap tax. This is something that we continue to advocate. Then having exposure to large cap tax definitely is a favorable choice because they are the first beneficiary of the big tax cut, corporate tax cut. And I think this is a huge driving factors going forward to actually support a valuation. But the valuation at this moment, even for S&P, I think is close to 23 and 24, which are actually above the one standard deviation above the 20 years norm. This is definitely is like a concerning, which definitely offer a lot of support for your attitude of stay vigilant, Rich. I agree with that, but having exposure to Bitcoin, Ethereum, and other crypto mainly was tied to the stablecoin, the issuing of stablecoin. As what we actually discussed, I think the successful launch of the stablecoin served the national interests of the United States to continue to be able to issue the more of a treasury bill. So from that point, we actually will see some national support to actually to have a higher price for crypto, including the Bitcoin and also other stablecoin as well for the national interest of the United States. So we actually definitely will see back direct or indirect support from the U.S. government from the current administration for the it is rather stabilizing of the crypto price. So from that perspective, we definitely need to participate, even though a lot of people maybe in the future when they actually come back, they do not see they cannot understand the risk factor within the crypto. Definitely a huge risk factor within that. This is no one would argue otherwise. But here is from the allocation portfolio allocation point of view, we definitely go into that. And the other issue from the from the international market perspective is we see the Europeans capital and South Asia capital, they need to rebalance or they need to readjust their risk exposure to the US dollar and the US market. And that's why they will actually find the only place which actually is in Hong Kong and China or even India to actually do the risk adjustment allocation. So this is from the rebalancing perspective. We'll continue to see that trend will go higher. And if we actually look at the performance of the U.S. dollar, U.S. dollar is going weaker and weaker from here. When the U.S. dollar going weaker and weaker from here, that definitely lift the U.S. stock market historically. So here, even though we continue to see, hey, we actually might see the high tariff causing the high inflation, but I also see a lot of like a supporting factor we call tailwinds. I mean, for the U.S. stock market continue to go higher and higher here, and if um, President Trump's administration can successfully issue this additional, like a couple $1 trillion U.S. Treasury bill, we actually might see another like a technical bull market of the U.S. stock market. So this is something that I think, given all of the risk and awards here, definitely I will not look bearish over the U.S. stock market and continue to be maybe slightly bullish from here as well. So that's my argument, Rich and Blake. I know that you might disagree. So you actually
No,
focus.
I agree with you, Tony. I think you're right that the excess liquidity here driving asset prices to all-time highs. I think that is happening and will continue to happen. But I think that to me is an argument for the Treasury not cutting rates instead of cutting rates. But I think you touched on something. I mean, first of all, earnings are going to be super interesting because you're right. You've got the capex expensing in the the tax policy change. You definitely going to want to hear what companies have to say about that. We want to hear what companies have to say about tariffs for sure. But the last thing you mentioned here, and I brought up the page here on cryptocurrencies as we're starting crypto week here on July 14th, and we
Yes.
can see Bitcoin's at 120 all-time high. Ethereum is back above 3,000 and heading higher. Um, you mentioned the stablecoin bill and the stablecoin legislation, which has passed the Senate, it's now working its way through the House, and we know that the president is definitely on board with this. Not just the president, but I think the entire administration, because to
Yes.
me, there's a to if you look at the two big constituencies that will benefit from stablecoin legislation, one of them is clearly the Treasury itself, because via the stablecoins, as you mentioned, and a whole new source of demand across the Treasury curve from those who have the stablecoins, and so the Treasury Secretary sees a whole new audience to sell bonds to. He doesn't have to worry about foreign investors anymore, and doesn't worry so much about the FX moves and the weakening of the dollar. But I think the other part of the lobby is the corporate lobby, because we know that Walmart and Amazon, the big players, that a way for them to circumvent JP Morgan, et cetera, certainly saves them billions and billions in fees. And so that's a big potential positive. But correct me if I'm wrong, Tony. I'll punt it back to you. As bullish as I am on the stablecoin legislation getting through, and why I think that investors might want to really consider Ethereum and Solana as huge beneficiaries of this as we move to a decentralized finance world. Stable coins and taking some of this flow of capital outside of the banking system is going to serve to reduce the credit, and therefore M2. I mean, and potentially has the unintended consequence of slowing down the economy here. Is that something that you see as a risk that we want to think about? I know people are only talking about the benefits and not the risks, but that's one thing that I see. As bullish as I am on it, I think that that's a potential risk.
Oh, no doubt about that. I think even the World Bank agree that the continuously support of the stable coin from the U.S. government would actually cause some kind of instability of the U.S. dollar as well, given all the benefits. It's like we actually have been talking about the benefits in our last two episodes. Now here we actually can maybe highlight some of the risks, apparently, because the collateral of the stable coin um, are actually U.S. Treasury or U.S. dollar, right? And if we actually continue to basically release or maybe encouraging more of the companies or legitimate issuers of the stable coins, we are going to see more of a liquidity of the stable coin holding the U.S. Treasury and holding the U.S. dollar. That part sometimes it's outside the regulation of the regulatory agency. I mean, especially from the Fed or others like a government agency, like a SEC as a point of view, because of the nature of the blockchain technology underlying, and they are actually flowing outside they really can flow outside the domain or U.S. territory outside without regulation. That being said, apparently, without this like a relatively or successful regulation of the stable coins, and we definitely could see huge risks of the financial instability because of that. And I think that right now the right legitimate reason for the current administration to support the stable coin is that because we are going to actually attract more of the liquidity to actually for the US dollar. Which definitely, I think, from national interest point of view, we need to have a stronger U.S. dollar. We do not actually want to have a weaker U.S. dollar uh, uh, from this point on. But as a global currency reserve, but now here is whenever we have enough stablecoin outside of the U.S. Territory without proper regulation, then one day or the other, we do not know. It could be just like a hidden bomb, could easily just exploding sometime out of nowhere. So that we do not know. Okay, so that's the hidden risk, a huge potential risk. It's like with the continuous strength of the stablecoin and crypto market. But in the short term, in the short run, because of all the government support, especially from the U.S. Government, I would say this is I will continue to see the strength as well. What I
So
yeah,
I know,
Rich.
I know, Blaine. Stable coins and crypto is not your sweet spot, and now where you're looking to. But I want to ask you the question a little bit differently. If as we kind of go through earnings, what you're hearing from the companies is, yeah, we they might be having to eat a little bit of the tariffs, but on the flip side, they're be able to expense all of their capex and get that tax savings. And they guess what? They might be able to issue their own coins right now and save themselves billions of dollars of interchange fees. I imagine you might be thinking that they might be a little bit better credit than otherwise because the capital would be flowing to them. And while credit spreads try to widen out, and I just have just a generic Moody's BAA index less treasuries here, from the cycle tights that we saw around 140 basis points at the end of 2024, widened out to 2% around Liberation Day, but now have credit markets have been tightening. I don't know if it's been on a lot of activity, but seem to be tightening here, and we're made back half that move. Another sign to me that maybe markets are feeling rather robust, and there isn't a need to cut rates. But what do you think of what the price action that you're seeing in the credit markets?
Yeah, and since we last spoke, my background, private credit, broadly syndicated loans has seen significant tightening along, with price increases, the amount of loans trading above par, the amount of loans that have gotten near par, all of that has tightened spreads. A lot of that seems to be due to there's been activity in the loan market, but it's been companies that are refinancing their debt at lower levels, which is that's positive that they're able to do that. But that's against the backdrop of continued, say, CLO issuance that's increasing the size of the pie, that's demanding credit, and there just hasn't been an issuance of quote unquote new credit. And I think that somewhat goes back to the beginning of the year when we were talking about the expectations of a lot of M&A activity and a lot of regulations going away, that 2025, the capital markets were really going to open up, and we just haven't seen it. And I think that's just been back to things have been put on pause. So maybe we'll see that in the second half of the year as we got some clarity now about around the bill. Maybe we're getting some clarity more around the permanency of some of these tariffs, that we'll start to see some actual new issuance. But I think a lot of the spread tightening that you're seeing is just a lack of kind of supply on the new issue side. And but it's definitely to some of the points earlier made. I mean, the U.S. economy continues to perform. The resilient consumer, all this stuff bodes well for companies being able to come back and tap the markets and bring their interest costs lower. So, which is what the president wants to do as well.
Yep, and as you make a great point about this, the deal flow has been on the come now. It seems like for about 2 or 3 years, and
Mhm.
we're certainly seeing that impact in terms of the banks are not hiring as many people, the consultants are firing people, the technology firms are firing people. And those are the firms that are most at risk because of the high human capital from inflation. So that tells me that there's a lot of inflation out there, but and that the Fed shouldn't cut rates. But Tony, I'm gonna give you the last word on that as I bring up the Taylor rule here, Taylor rule screen here, which tells you that Fed funds is exactly where it should be in line with the Taylor rule. If we look at just core PCE and you know and then look at the natural rate of unemployment,
Yes.
it tells you right there that the Fed shouldn't do anything. The Taylor rule. If we wanted to use algos for the Fed instead of the chairman that doesn't know anything, I guess the algo is telling us 4.46 versus the current Fed rate at the upper end of 4.5. So I'll give you the last word because we've been beating you up a little bit on why the Taylor rule, if we look at inflation and unemployment, isn't the right answer here, and that the Fed should be instead cutting rates by anywhere from the 75 basis points the market's pricing into the 3% that the administration's calling for. Why is this not the right answer?
Yeah, Rich, I like you to bring up as like a Taylor rule table, which is actually very super interesting. It's like here. Actually, this is give us a lot of reasoning why I actually argue that Federal Reserve should cut the interest rate much faster, especially from the unemployment ratio here. And given the current inflation level and also unemployment level, which is at historical low, this is 4.1 as you actually you put it, or even maybe adjust it like a 4.2 percent unemployment rate, then definitely we can actually support the current level of the interest rate is okay, it's a fair, but here because of the like a fast innovation, fast evolution of the AI technology, we continue to see that the large tech firm lay off a lot of people. I mean, including also the financial service firm Goldman Sachs, BlackRock, continuously laying off a lot of the existing employee and might even hide the freeze, I think, in the foreseeable future by actually giving less and less opportunity to new fresh graduate. So I would we would definitely see the unemployment rate would go higher. And whenever we actually started seeing that, we will actually see it like not like a linear unemployment rate would spike in an unlinear phase and could even leading to an exponential or even like a shock phase. People, even the administration of Federal Reserve might not anticipate it given the speed of the innovation. And a lot of people just argue that maybe the AI innovation is the last innovation of the human being. Blaine or Rich, what do you believe in now? Just like there might be the last innovation before we see other things. Could really be true because it's really deflationary for the AI adoption and AI innovation. In fact, the faster it goes, just like you see Meta and Google, NVIDIA, they all fight for the AI people, but only for a small group of AI people, like Meta using giving away like a $200 million just to hire one AI like an engineer from Apple, right? So we probably could sell. I'm willing to sell myself for 20 million or $2 million. But I mean, if you look at this as the face that those companies will not actually hire as many of the new fresh graduate as what they did before, and even from the UFI we would from data that we definitely see this kind of thing, and then more and more of a layoff from the government, Goldman Sachs and Citibank, Bank of America. This is telling us that this we definitely we will see the unemployment rate go much higher from here. So from a preemptive perspective, the Federal Reserve should cut the interest rate to actually to avoid that kind of things unprepared. And as another, I think the stronger reason, as what we discussed earlier, that if Federal Reserve does not cut fast enough, this is a financial instability outside of the United States could actually cause unintended consequence or rippling effect for the U.S. economy and U.S. stock market as well. So this is like give us a stronger reason. I think just for I think Federal Reserve the low interest rate to prepare for that. I mean, if they can do the preemptive cut in back to 2024, right last year, why couldn't they actually do the preemptive cut at this moment? Like given so many factors actually supporting the faster car. So that's my final remark, Rich, Blaine.
Okay, Blaine, I'll give you the last word. Preemptive cut from the Fed with stock prices and Bitcoin prices at all-time highs. Um, and credit spreads moving back to all-time tights. What are your thoughts on that?
Well, I would say that the market believes that things are pretty loose still at the current rates, and I don't know that, going looser, that the market's telling you that that needs to happen. But I do think we have a theme for our next podcast, and that is the preemptiveness of the Fed, and should they be in that business? Because I think that is an argument, about how far down that slope do you want to go? Because I think you open up a whole different, can of ideas there about rate movements. But yeah, I think, the market's telling you, things are kind of good at the level we're at, and a wait and see approach is they've got that room. So that's my take.
Absolutely. And so in we'll kind of leave it there that this, the next couple of days we're going to get CPI and PPI. And I imagine if the inflation numbers continue to nudge a little lower, there'll be further calls for the Fed to cut rates. I also think that we're going to get quite a bit of company data here in the next few weeks, and we'll have a better sense of what the companies think about tariffs and tax policy, and AI impacts on their earnings. So with that, we'll leave it there, and we'll reconvene in another couple weeks to talk about what the Fed is about to do or maybe has already done, and more importantly, what we're hearing from the companies themselves at that point. So Blaine, Tony, thanks for joining us, and look forward to catching up in a couple weeks.
And
Looking
thank
forward
you,
to it. Thanks, guys.
Rich, Blaine. Yeah, look forward to catching up again.
And thanks to everyone who's been listening. Make sure you like, share, and subscribe the Macro Matters podcast so that we can get our numbers up, and continue to get that access to as many people as we can. Thanks, everyone.